Well, welcome back to another episode of the Financially Free Journey podcast. And I am your host, Courtney Dyer. And today we have a very special guest. It's Sarry Ibrahim, and he is a financial expert. He is licensed in many things. I mean, his accolades go on. And I'm so excited. He actually has his own podcast as well. So it's really fun to be able to do an episode with fellow podcasters and to be able to talk about different financial concepts. And Sarry's actually a financial consultant himself. And so I'd love to give him a warm welcome onto the show today. How are you doing?
Hi, Courtney. Thank you so much for having me on. I appreciate it.
I am excited. And guys, I was talking to Sarry right before we started recording, and I said, so how many podcasts have you been on? And he just casually said, over 100. Oh, no big deal. He just, has done a monumental amount of podcasts. So that goes to show you guys that over 100 different shows said, yeah, he knows what he's talking about. He's an expert. Let's bring him on to bring value to our listeners. And so I just wanted to point that out at the beginning here. But another thing too, guys, if you listen to the end, Sarry's going to be giving away a prize, and we all love prizes and giveaways. So just thought I'd throw that in because we'll talk about it more at the end. But Sarry, give the listeners a little bit of a background on yourself.
Well, thank you, Courtney, for the warm introduction. I'm happy to be here. I started my journey about 6 years ago when I was doing my MBA in Chicago, and that's where I currently live in Chicago. I was doing my MBA and I started working at Allstate Insurance. I was in sales doing auto insurance, homeowners insurance, commercial insurance for small business owners. And then I made a transition after that, after Allstate, and after graduating my MBA, I made a transition into healthcare. So I was working with companies like Blue Cross Blue Shield, Humana, Cigna HealthSpring as a Medicare consultant. And a lot of my clients were older. They were like 64, 65 years old, merging off of their employer plans and then onto their own individually owned Medicare plans. So in other words, I was a Medicare broker for a few years, helping clients transition. And I loved doing that. I loved helping clients find the right plan, the right networks, making sure everything was aligned with their goals and their needs and wants. And it was super focused. It was a lot of retirees from the city of Chicago. So they worked for the city of Chicago, they retired. And that was my job for a few years. And during that time, one of my clients asked me if I could help him with life insurance. We started to build a good relationship. And he asked if I could help with life insurance, specifically cash value life insurance. And he said briefly that it could build up, the cash value can build up and eventually pay for the policy. And I had no idea what he was talking about, but I was like, that sounds pretty...
What is this?
Exactly. I was like, this sounds pretty interesting. So I told him I would do research for him and I get back to him. And I went to Amazon, believe it or not, I went to Amazon and I searched for books on life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. And it talks about the strategy called the Bank on Yourself strategy, invented by Pamela Yellen. It's also known as the infinite banking concept. For a lot of real estate investors, know it as the infinite banking concept. But I was kind of super focused and super hooked on this concept now, not only for my client that I could help him with, and not only for retirees, but for anybody who essentially wants to save more money for the future and take back control of their financial life. So I made it my job now. I joined the Bank on Yourself organization, went through their training program. It was like an 8-week rigorous training program, went through that program, and then started the company Financial Asset Protection. And our main focus is the utilization of the infinite banking concept, also known as the Bank on Yourself concept. And it's my goal now to tell as many people as possible about this concept and how it could help them take more financial control of their life, which is why I really wanted to be on your show and to kind of share the strategy with your audience.
Well, and I can just feel the passion, guys. We're being able to see each other because if you don't know, these all get posted on YouTube as well, so you can see the interviews. But if you're just listening to the podcast app, you can probably even just hear the passion that Sarry has for this concept. And it's so interesting. I think a lot of us, whether it's finance or not, like you have this moment in time where you can pinpoint where you developed a passion for something. And it sounds like when that client asked you about that, and you went to Amazon, I love that. You're like, okay, Google, what is this? I need to learn. It's changed the trajectory of your career and your life. And you've really developed a passion to help tell as many people as possible. Because a lot of times in finance, it's like you find out something, you're like, why doesn't everybody know this? Mm-hmm. And this is one of those concepts, right? Mm-hmm. So I think it's a perfect segue into what is the Bank on Yourself? Like explain this concept to the listeners and what it entails exactly.
Yeah, well, I briefly mentioned it when my client asked me about cash value life insurance. So that's exactly what it is. It's cash value. It's the utilization of whole life insurance, which kind of to take a step back, whole life insurance has two parts to it. It has the life insurance part, and then it has a savings, like a cash value savings account portion inside of it. There's also term life policy, which is term is just a set period of time. It's only life insurance. There is no equity or cash value in it. So kind of just to differentiate between term and whole life. We're talking about whole life and cash value whole life. Now, Courtney, a lot of people are like, wait a minute, I thought this was about finance. What does it have to do with, cash value life insurance? And it does. And so the utilization of cash value life insurance, it earns dividends and interest over the years. It grows. In other words, as you are allocating funds to this policy, it's growing, it's earning interest, it's earning dividends, it's accumulating cash value, and also the death benefit is also increasing too. But we're mostly focused on the cash value part of the policy. And we are utilizing this. A lot of our clients are real estate investors and business owners. So what we're doing is we're utilizing these strategies, these policies to grow cash value and then to be able to access the cash value to become our own sources of financing. So I know I'm throwing a lot out there, but that's in basic terms, it is a utilization of cash value whole life insurance for self-banking purposes.
I love that. And that's where I really wanted to tie it back to the name of Bank on Yourself. Again, you are taking the lender out of the equation and becoming your own lender. So you pay a premium into this policy. The premium then gets invested into a separate investment account. It builds value. You get to participate in the market. It builds value over time. And you build up that cash value, right, in the policy. And you can actually borrow from the policy, hence making yourself the bank. And it's just an amazing concept that a lot of you said real estate developers and things like that use because they're constantly needing to tap in to buy more assets that generate more income, right? So it's a great strategy to build wealth if it's something that you feel, meets your needs. And so now that you've been in this industry, right? And you've made it your passion. What are some of the biggest misconceptions around this concept that you've come across?
Awesome question. So misconception number one is all life insurance is the same. And then so people might say, all right, term, universal, whole life, it's all the same. What's the difference? So I might as well just do the cheapest policy, which is term, and then just keep it at term only, and then invest in different places. And although that's a strategy a lot of people use, we're not talking about the bank on yourself concept does not involve only a death benefit focus. It's not just about life insurance only. It's about becoming your own source of financing, kind of eventually cutting out the lenders and taking back control of your financial life. That's the underlying objective of this concept. If somebody wanted just life insurance only and that was their main focus, then yeah, of course we would just do term because it tends to be a lot less in cost compared to whole life insurance. But the misconception here is that people, once they hear life insurance, they put it all into one bucket. Another misconception is that whole life insurance, let's admit it, it has a bad name out there, especially people who follow Dave Ramsey, Susie Orman, and not to bash them, they say amazing things. But when it comes to whole life insurance, there's some things that they're not advocates of whole life insurance. And a lot of people tend to look that way when it comes to whole life insurance. And the reason why is because over the years, a lot of agents were selling whole life insurance as investment vehicles. And it's not an investment vehicle. It's a saving strategy that can be used alongside investments. Big difference, right? Right. So a lot of agents were just saying, hey, instead of putting it in the stock market, instead of buying these investments, just put in whole life insurance. And of course, people were getting not tiny returns, lack of liquidity. It wasn't meeting their needs and their wants because it wasn't the right types of policies. And that's right. The objective of Bank on Yourself is that it's a special type of whole life insurance. It's not all whole life insurance across the whole US. There's about 1,200 companies that sell whole life insurance in the United States. We're only focused on like 3 of those companies because of what they could do and how they could adjust to meet the needs of the real estate investors, the business owners, the people who want to save for retirement. So the misconceptions are people just tie in titles. Life insurance is all the same, and then whole life insurance is all bad. And in both those situations, it can be true, but it's important to note that Bank on Yourself is a special type of whole life insurance that allows for higher liquidity and for the integration alongside other investments. So it's not an either or function. It's both and. We're tying all this together to find more liquidity.
I love that because again, finances in general is not a one size fits all. That's why it's really important to have a very high quality team of financial professionals surrounding you and being able to get really great advice, because you are great at what you specialize in and what you have passions around. So, make sure that you bring in professionals that can look at your finances, your objectives, your goals, and say, you know what, here's a portion that will work succinctly with the investment strategies that you have. And as you had mentioned, there's, big names out there that are not advocates for this type of insurance. And again, they lump it all under one umbrella, whole life. Well, it isn't a one size fits all. So again, it's about diversifying your assets, your saving strategy, and making sure that you're generating income for yourself later in life. Or, when you have major life events like wanting to buy real estate, for example, this is a great opportunity and concept that can be used and employed in that time in your life. So what kind of risks do you see people face when they don't protect their assets? So, we've got people that just do like term life, for example, or a lot of people don't have insurance at all. What kind of risk do people run into when they don't make this a priority?
Yeah, well, to tackle the first one, the lack of life insurance is a big risk because of premature death. Anything can happen to anybody at any time, especially if you are married, you have kids. If there's a financial obligation there, right, for your mortgage, for your kids' college savings, and these could be covered through life insurance. And if it's, for example, if we go back to term life insurance only, we're talking about minimal dollars to cover almost your entire portfolio. And then, of course, on the whole life policy is that you can have the life insurance part with the cash value to accumulate in that. So it's a life insurance risk too. And another risk too could be that if somebody, for example, has all their money in a volatile investment, and not to name a specific type of investment, let's just say it's a volatile investment and they want to get super high returns, or they're aggressive, they want to get higher returns. That's also a big risk too, because what if something happens in the stock market? What if something happens in the economy or in the real estate market? Something happens, something bad happens. Now that's exposed too. So definitely, look, as you mentioned, diversification is key, and having the right team is key. And it's almost like you want to draw like a circle, right? And different parts of it have to be covered, like your life insurance needs, your long-term care needs, economic and financial needs, your mortgage, different parts of your life have to be checked off to cover all elements of risk. And this is something that a team could do. One person specializes in the investment side, another person specializes in the life insurance side, another person specializes in the tax liability, which is a huge part too. So yeah, definitely a lot of different checks that need to be kind of looked at in the financial planning situation.
Absolutely. Well, you touched on something that I wanted to reiterate is, you mentioned, like, let's say you have all your money in the stock market, and as we just saw within this past 12 months, major volatility, corrections happen. They are expected. It is a part of the cycle in the market. We have sector rotations and different things where you're going to see things go up and down. So let's say, for example, you've got all your money tied up in the stock market and it had a 30% correction, and you have a liquidity event happen in your life and you need to access funds. You don't want to sell your stocks at a loss. You need to allow your investment to have time to recover and be able to tap into a different source of income to be able to meet whatever that liquidity event is that's happening in your life. And that's another great point, to be able to have something like the bank on yourself, in play when you look at your total financial picture. One thing I wanted to ask you is, let's say I'm a listener right now and I'm like, well, how do I know if banking on yourself strategy is good for me? Like, what's a mental checklist that they could go through to say, yeah, this is something I should look into?
Yeah, it's an awesome question. So like number one is it's a long-term strategy for sure. It's a 10-year, 20-year, 30-year strategy, long-term. That's one big checklist. Another checklist too is that I don't want to say there's a down point to it. For example, like if you are putting in, it's not one of those strategies where you could put $10,000 in and then take out $30,000 year one. It doesn't work like that. There's a premium to cash value kind of ratio. And in the first few years, the premium to cash value ratio is about 50 to 60%. So that means if somebody is putting in, let's just say $10,000 a year into the policy, year one, their cash value might be $5,000 to $6,000. So a lot of clients would be like, wait a minute, what happened to that, discrepancy of the delta of $5,000 or $6,000 in the policy? And that goes to insurance expenses. So the policy is not, it's not too good to be true. It does have its fees. It has, just like any other investment or a savings or life insurance policy. So, but the benefit is that you get that back eventually through accumulating dividends and interest. And in other words, there is a break-even point and then plus more. So you have to be comfortable with that kind of small dip in the cash value compared to the premium dollars put into it. So again, if you're putting $10,000 a year in, it might take you a couple years to be able to borrow against it, to have substantial cash value in it, to borrow against it, to be able to use it for whatever you want. There are no restrictions on what you could use the cash value for. But that's just two things that people have to be comfortable with. It's a long-term strategy, and you're not going to have all your money in cash value immediately in year one or year two. It takes time. You could borrow immediately, but you can't borrow as much as you've put in the first few years. Eventually, you can in later years. Another thing too is that when you're borrowing from the policy, you want to make sure that you're actually paying it back. You don't have to pay it back. It's a non-recourse loan. There's no credit checks or credit requirements behind the loan. You're essentially banking on yourself. You're borrowing from an insurance company that you're a mutual owner of. You have control over the loan payback, but you want to be able to pay it back so that way you can keep borrowing and doing it all over again, becoming your own source of financing. So those are just the three things that you want to take into consideration, and kind of a checklist to see if you want to do this.
Right. You have to be okay with the fact that you're creating a strategy in the long run. So let's say, for example, that in retirement, you want to be able to have multiple rental properties, right?
Mm-hmm.
You want to be able to maybe own some multi-units, and that's like your 10-year strategy. Well, that's something that you need to know. Okay, if I start putting money into this now, by the time I'm ready to be able to buy these units and be in that portion of my financial picture, I will have this cash to tap into. So I think that's important to understand, is like planning out the events that you have coming up in the future, and if this makes sense to be able to tap into it. So I wanted to kind of give an example to the listeners of if that's something that they think in the future, yeah, that could meet my needs. So what's another takeaway? Let's say the listeners just take away one thing from this episode and it's the only thing that they remember. What do you want that to be?
Oh, absolutely. I want listeners to remember to always think like a bank. And what I mean by that is that banks are the biggest purchasers of cash value life insurance. They have collectively about $200 billion in life insurance. And the reason why is because of the liquidity behind it. Banks borrow from, one of their sources of borrowing is through whole life companies, the whole life insurance companies. They borrow and then they loan it out at higher interest rates. They buy, for example, at 4%, 5% interest from their whole life policies, and they sell it at 10 or 15% through credit cards, auto loans, mortgages, different places that they would sell those loans at. So this is something that's not exclusive to banks. Anybody could utilize these strategies. A lot of our clients are hard money lenders in real estate. So what they'll do is they'll have their whole life policies. They'll borrow at 5% interest from the insurance company and then loan it out at like 12 or 15% plus points or plus fees alongside that loan, and then have a split in between the amount of money that they borrowed at and the amount of money they sold it at, like they're wholesaling money. And they're also continuing to earn money in their policy this entire time. There's no interruption in their growth. So if I want the listeners to remember one thing, it's to think like a bank. Remember to think like a bank. And ironically, the name of our show is Thinking Like a Bank.
That's fantastic. That brings me to the next point, is where can the listeners find you? Because again, I want them to really, this is a concept that doesn't necessarily align with a lot of traditional thinking when it comes to investing or building wealth. And so it's something that they're probably going to have to do some additional research on, and doing things like listening to your show, for example. And so your podcast is called Think Like a Bank.
Yeah, it's Thinking Like a Bank.
It's on Apple Podcasts, right? I found it on there. So I'm assuming it's probably everywhere that people listen to podcasts. They'll be able to tap in and listen to your episodes. And even though he's been on 100 different shows, he has just launched his own show. So it's fairly new, and you can probably binge listen to all of the episodes he has live. So you can really dig in deeper into this topic, because this is something that the listeners need to make sure that they really do their research and not just say, nope, not for me. I'm not wealthy enough, or, oh no, I'm not at that point in my life, because it's surprising when you do research into something like this and say, yeah, actually, I could use that. So I want them to definitely go listen to your show. Where else can they find you?
Yeah, they can go to our website. It's finassetprotection.com, FIN assetprotection.com. And I'll actually throw in a free copy of a book called Becoming Your Own Banker by Nelson Nash. So Nelson Nash invented the infinite banking concept. I'll send you a free copy of the book, Becoming Your Own Banker, to kind of give you a layout of what this concept is and how it works in basic terms.
That is amazing. Okay, so guys, so make sure that you go to his website. I'll make sure to put that in the show notes on my website and also in the episode description so people can just click on it if you're driving or whatever, guys. And then that way you can really tap into getting that free resource so you can really understand this concept more. And I want to say thank you so much for taking the time to come on today, because this is a concept that I have done some research on, and I thought we need to have an expert come on. And I would, be safe to say that you're an expert on this topic. And thank you again for your time. And guys, as usual, make sure that you're following me. It's on TikTok and Instagram. It's at Financially Free Journey. I post daily tips, motivation videos to help you with your financially free journey. Until next time.